I hope you enjoyed the virtual keynote address. Let us now move on to our first panel discussion, ESG Risks, the cost of underpricing, which will be followed by a Q&A session. During the discussion, please feel free to send in your questions through the QR code pasted by your seats. Due to heavy traffic, you may need to refresh a few times. In any case, during the Q&A section, if you would like a microphone, please raise your hand and members of our staff will pass it to you. May I now please invite our moderator, Mr. Kulvech Janvatanavit, CEO of the Thai Institute of Directors, up on stage. We are honored to have with us 3 distinguished panelists. May I please invite onto the stage Mr. Shreejesh Nair, Chief Risk Officer at Citi, Mr. Mikkel Larsen, Chief Sustainability Officer, DBS Bank, and last but not least, Mr. Edward Emmanuel, Partner at Oliver Wyman. Welcome onto the stage.
Wow. Even this morning, the opening speech was very powerful. We listened to the governor of Bank of Thailand talking about sustainability of our industry depending on sustainability of the public trust. So we have to look far and we have to look wide, far in terms of longer term and wide in terms of impact on environment, social. We listened to him talking about banks has underpriced ESG, and that leads to undermining public trust. And then he gave us 3 examples, and each example reflects different angle, different dimension of the problem. The first one is Wells Fargo about market conduct. The second one about environment impact on palm oil that could lead to public trust on the banks being seen as lending to those pollution maker. And the last but not least, social impact. And we saw that the bank could also cause the bubble of the property market. The end of the chairman of NGFS is really remarkable when he ended the opening speech by saying that sustainable financing, let's in future not use this word because all financing is sustainable. So here we are today. We have 3 views. We had this conversation about half an hour ago talking about what we could be talking about. And I can reassure you that we are going to be having a very rich conversation. Of the 3 gentlemen, one from Citibank, another one from DBS, and Oliver Wyman. Many years ago, sustainable banking is not on our dictionary, right? But right now, we have witnessed in your operation or the operation that you have seen, sustainable banking become the way the bank operates. So this session, we just want to reflect on how people underprice ESG and how they wake up to the reality. So I would like to start with Citibank. So please, tell me a little bit about yourself also. Introduce yourself as what is your role in Citibank and also what is the wake-up call of Citibank. Thank you.
Thank you for that. Shreejesh Nair, I'm the Chief Risk Officer in Thailand, but I do cover ESG, that we call it as ESR, Environmental and Social Risk Management for Citibank in Asia Pac. So apart from Thailand, I've been exposed to the other countries in the region where we have been taking care of project finances and other loans which essentially have ESG angle to it. There's an interesting element in the previous conversation. and I've been hearing it quite in a few conversations also in the past, ESG is not just reputational risk, right? I mean, people have been associating it with reputational risk, but it goes far beyond that. And where should it start? That's one question that people have been asking. It's truly honored to say that it should be in the boardroom, and it also needs to be a culture which is inculcated across all the individuals within that organization. If each of us thinks ourselves, when we actually go out to the client and have a conversation, the moment you start having an interactive discussions around how do you do the business, it helps both ways, both for the corporations as well as for the financial institution. Since this is a wake-up call, I wanted to take you back into history with Citi when we had that moment, right? That surprise moment. And indeed, we started pondering deeply into how should we, try to resolve these kind of issues and take it into our decision-making process. It's important to note that this incident was back in early 2000s. How do you respond to these, right? I mean, and this is not a unique situation, All the banks sitting out here, you never know, there are NGOs watching. There is a lot of right-way activists. There's a lot of public, oversight into what products you sell, how do you sell. There's a lot of market conduct initiatives which was done. So people are educated, and what happens with that is, I hope this is only one of those instances that a bank gets shamed like this, but effectively, this just gives you that opener in terms of how you should be looking at these issues.
Thank you. That is, can you imagine yourself waking up one day and with this kind of advertising is absolutely a nightmare. And this is what we call public trust issue. So let's move to DBS. Mikkel, so what is your wake-up call?
Thank you very much. The first thing I wanted to say is when I saw that video, I was looking for a scissor actually. It's quite impactful. So my name is Mikkel Larsen. I'm the Chief Sustainability Officer of DBS. DBS, for those of you who do not know us, is a large regional bank. So in other words, we're lending to most of the sectors in the region and are therefore confronted with the social and environmental issues that are involved in all of these sectors. So our journey on the social aspect was probably deep in our roots as a development bank of Singapore. But adding the environmental aspect came about 3 years ago. And although it didn't come as a result of a single large event, it certainly was amplified by at least 3 events that I can think about. The first one was the haze event that the government spoke about, which in Singapore took a very quick turn and a life of its own. It led to, first of all, certain supermarkets boycotting palm oil from Indonesia. It led to the establishment of toolkits to how to prevent haze or take precautionary actions. It led to the banking industry coming together to draft responsible lending practices, and it led to every single bank having to think through why they were lending to palm oil. Now, in our case, we had to think long and hard about our engagement in palm oil, and we came to the realization that palm oil can be done sustainable, but if it's not done sustainable, and that means both socially and environmentally, it can cause tremendous damage. And so we toughened our stand so that today we have one of the toughest stand on these things. And we did this both because it's the right thing to do, but because also we saw both the reputational risk and the credit risk that could be involved. The second thing that amplified was the more recent discussion about coal-fired power plants and the financing of those. And again, here the issue was one of environmental degradation, the fact that coal-fired power plant is the dirtiest form of fuel. And again, we had to think very long about the balance between getting social and environmental factors right. It's very easy to see the environmental degradation that it leads to, but it's also true that for some countries this has been a part of their energy mix for a long time, and we need an orderly transition. How do we respond to that? Again, we considered both what was the right thing to do from a balance point of view, but we also considered the alternative energy sources that was now becoming viable alternative. And we realized again that we had both a reputation and a credit risk. And as a result of that, we recently stopped financing new coal-fired power plants. And the third one, and a very recent one, was we conducted a number of stress testing analysis looking at what was our exposure to climate risk. And although that might not have been mind-blowing in terms of what we learned from, it certainly led us to new conclusions around what are some of the sectors and that we are mostly exposed to, but also the diversity within a sector. Two companies within the same sector can have very, very different exposures to environmental and social risk, and we have to take precautionary actions in some of those things. So if I summarize all of this, it leads me to a number of conclusions. One is that in the short run, reputation risk probably dominates, but in the long term, this turns into credit risk and business risk. And by business risk, I mean that sometimes it's a little bit hard to get a credit risk officer to accept that this is important, because if you have a lending portfolio that's 3 to 5 years long, some of these things arguably only come a little bit further out. But we see in some of, and that leads me to my second point, we see that when some of these things start to accelerate, they accelerate really fast. When there is a focus on climate change, industries that gets villainized, rightly or wrongly, will lose its business very, very fast, and therefore you would be left with stranded assets. But my third point is also we gotta act appropriately and not rashly and bowing to whatever pressure there is. We gotta think through what is the right thing to do, what is a reputation risk that we face, and what is a credit risk that we face. And based on that, we have to find a balanced response to each one of them. And my last point is that this is just the start. When I mentioned palm oil, I mentioned coal, we could mention, I think you were talking about fisheries, but there are a number of these sectors. So we got to think through each one of them and why we are involved in each one of them. Thank you.
Thank you. We are just at the start, and this is just palm oil, this is just fishery, but what's next? So now let's turn to Mr. Edward Emmanuel, and you are not a banker.
I'm not a banker. So.
But you can talk representing the whole bank in Australia.
Yeah, thank you. So Ed Emmanuel is my name. I'm partner in our financial services practice at Oliver Wyman. So we're an advisory management consultancy firm. I'm based in Sydney, but I'm fortunate enough to come to Thailand pretty frequently. So hopefully later on in the conversation we can talk about translating some of the experiences that we've had in Australia to Thailand. I was a banker, right? So I was at Westpac 4 years ago. I left Westpac. And there was a comment earlier around the Dow Jones Sustainability Index. And when I was at Westpac, we were incredibly proud to be number one on that index for a fairly long period of time. And so I think if you think about ESG as it relates to the Australian banks, for whatever reason, the S and the E elements have been reasonably well mature in the Australian banks for some time. And I can only presume that was because of the natural footprint that the Australian banks have as it relates to mining and coal, dirty coal exposure, as well as all the mining activity. So a big focus there on the environmental impact of a lot of the exposures that have. And frankly, many of the portfolios in Australia now don't actually have a large amount of direct exposure into the mining sector, for example. But I'm here today, I think, more from an E or an S perspective, but more on the governance side of things. So as far as a wake-up call, if we're sort of thinking about the first phase of questioning here is Australia has had a huge wake-up call as it relates to governance, culture and accountability. For those looking at the paper, you'll see a few events. Now, that Wells Fargo was mentioned earlier, which we look at closely as an example. I can talk about some learnings from out of the Wells Fargo case too. But in Australia, about only 3 years ago, the APRA, the prudential regulator, surprised the market by announcing that they'll be doing a prudential inquiry into the Commonwealth Bank of Australia. Now, CBA was absolutely the iconic Australian bank, incredibly successful quarter-by-quarter returns, and revenue growth, the very, very high regard in the community, a lot of trust within CBA. There had, however, been a number of missteps over the prior years. The straw that broke the camel's back was an anti-money laundering issue, and a clear exposure that the governance, the controls, the flow of information through the organisation as it came to complex and sophisticated project management disciplines were flailing. And anti-money laundering is a good case in point because it is so complex and it incorporates so many different stakeholders, not just within the bank, but out in the community as well. And so I was lucky enough, I don't know if it's lucky enough, but fortunate enough to be involved in the prudential inquiry into CBA and into the governance, culture and accountabilities frameworks and practices. And I think if you look at, from the outside and looking at the Australian banks, from a policy, from a procedures perspective, from a board papers perspective, tick, 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 very, very good, world leading in regards to that. However, when it came to implementing policies, processes in place, making controls really work and testing those controls and having a focus on the non-financial risk elements of the banks, that's when the cracks started to emerge. And a number of things were driving that. We talked earlier around remuneration. That was absolutely a case in Australia. Now, there are no, in the sense that the quarter by quarter returns, a big focus on ensuring quarterly revenue targets were hit and so forth. Sales targets are now effectively gone from Australia. There are no more sales targets out in the branches, no more sales targets in the institutional business as well, and replaced very much by behavioural scorecards and the ability to ensure that we can measure behaviour, measure the culture and the interactions that employees of the bank have with their customers. So that was a driving nature. One of the other things to talk about, particularly given the audience here, is the governance and the relationship between the board and the management. In the CBA case in particular, given, and there's some hypotheses here, and we referred in the report to widespread complacency. And given the financial success of the organisation, it was natural, we think, to have some level of complacency. But what that had created was more of an advisory relationship from the board to management, less of a review and challenge or a challenging relationship. So it was referred to by one executive as a bit of a walk in the park to go and present a paper to the board. That's changed very quickly. So now you have a lot more of a exploratory engagement with the board from management. You have a lot more humility, a lot more honesty going up to the board as well around what's really going on through the organisation. Again, very important as it relates to ESG related matters to ensure the board has sight around what's going on through the organisation without getting stuck in the weeds. And that's a challenge of management to ensure they are escalating the right issues at the right level of rigour and the right level of detail. Another outcome from the CBA review, but also more broadly the Royal Commission, which occurred in Australia as well, which is a government commissioned review into misconduct in financial services, is much clearer accountability. So the word accountability is used everywhere at the moment. I'm sure it will die down. And getting very clear on the difference between being responsible for something and being accountable and therefore having the consequences for something. We saw too often through the cases in the Royal Commission and with CBA that no executives really had full accountability of issues that were occurring in their organisation. Oftentimes the responsibility was delegated down and you would see poor junior folk who had spreadsheets that were doing the wrong thing, or the branch manager who was dealing with a customer in a way that they thought was right but actually wasn't. There were no consequences up the chain. So a regime that has been rolled out in Australia called the Business Executive Accountability Regime, it's a bit of a mouthful, but we call it the BEAR, B-E-A-R, is rolled out to clarify individual accountability across the executive team for the banks. That is still work in progress, but it mirrors the senior manager regime we see in the UK. And why? So there is clear line of accountability, so there is clarity at the executive level and further down through the organisation is who is responsible for what action should we be taking in order to fix things, and where the funding is going and the allocation of funding is going in order to fix things. The last thing I'll mention before we move through is culture. One of the key drivers for any outcomes and behaviours in an organisation is the underlying culture. The The banks in Australia have always been proud that they've got a very, very strong culture. Unfortunately, through the events of the last 3 years, that has been very much put to question. Similarly to the Wells Fargo case, whereby we had this case of selling 8 products to every customer was the thing to do. 8 is great, is the term that Wells Fargo had, and that came from the CEO all the way down. The unfortunate thing was it got misconstrued as it went down through the organisation, and the guy and the managers of businesses were told that they must sell 8 products to everybody, as opposed to the CEO saying, well, our value proposition and our values is very much we want to be a full-service bank to all of our customers. 8 seems like a pretty good number of products for all of our customers to have. 8 is great. It's got a good tagline to it. Let's make 8 is great. And unfortunately, as that manifested itself down through the organisation, these behaviours were driven through middle management, not really understanding the exact nature of that. And the reason I share that story is because culture, from my perspective, there's no such thing as a good or a bad culture. If the culture doesn't align with the values and the lived values of the organisation, that's when you get a breakdown in culture, that's when you get misconduct issues, that's when you get misalignment in incentives, and that's when some of these issues manifest themselves. So I'll leave it at that, but I'm sure we'll come back.
Thank you, Edward. Well, you just mentioned a very interesting point. All this ESG and underpricing, at the end of the day, it might come back to how the board and the management work together. So Edward said at the beginning that having policy is one thing, implementing it is another thing. The board and the management, how they engage with each other, and sometimes we use this word that the board has to represent the mindfulness for the management, have to challenge the management with questions. And then accountability has been pushed downward, and the culture is not in line with the value. So actually ESG and the issue might come back to how we work together. So that is interesting. Let me take that into the next question, Shreejesh, which is about Citibank. After those wake-up calls, how does management and the board work? How do they work?
Sure. It's a good segue, the way he talked about governance and the involvement of board. So ever since the wake-up call incident that I mentioned back in 2000 and the video that you saw, the first thing that the board did is they sat down, we went through our portfolios, decided which is our key target markets within those portfolio, what is our proposition, and indeed inculcate a value proposition. So we created a value proposition wherein we believed that yes, it is an important aspect into our decision-making process that we should understand ESG and get our clients to also engage with ESG and then see how we can scale it through. So it all started with setting up policy documents. So the first thing that Citi did is Citi became an EP, Equator Principle, as many of you know, a signatory. Equator Principle lays out guidelines in terms of what needs to be looked at when you do financing for anything which is probably causing ESG risk. It has guidelines around resettlement issues, land acquisitions, environmental degradations. To an extent, it also talks about climate change in a broader nutshell in terms of GHG gas emissions and stuff. On top of it, we went in and voluntarily incorporated IFC standards, which goes a bit more deeper in terms of analyzing and looking at ESG issues. So both of these guidelines, the EP, Equator Principle, and IFC, is a good start point for one to actually understand what are the clear ESG linked issues that you have or you want to actually target to, and then how would you go and monitor and make people accountable towards implementing those IFC and EP principles. So this is how we started back in 2002, 2003. Post that, we went a step further. We can do IFC, we can do EP, but that typically covers your project-based lending, your loan-based, your loan financings. What do you do about your working capital? What do you do about your other facilities that you extend? So why don't we look at having a sectorial-based standard? So we went a step further and we decided that it is important to have sector-based standard. So as I mentioned that we were looking at what is our key critical areas or value proposition, we started implementing standards for palm oil. We started implementing standards for coal-based mining. We have a standard for nuclear power plants. So essentially we started screening out industries where we believe that we have to be, because there is no one fit all, right? So for each and every industry you started to have, and it's a learning curve, as and when you started looking at issues, trying to figure out what is happening in the market, you started to inculcate your habit of upgrading and upgrading your standards. The third step came quite recently, about 3 to 4 years ago, where we said, okay, we now have compliance with EP, IFC, and now we have put in a sectoral standard. What next? Because things are evolving. One classic example that comes to my mind is the seafood fishing issue here, where there was slave labor and all this stuff. These are not addressed in EP, these are not addressed in IFC, or it may not even come in your sectoral standards. What we decided is we need to have a watch listing process. So there are sensitive industries and sensitive companies in various markets. We need to start following them for any negative news. We need to look and rely on some other tools. For example, Rep Risk is one, Sustainalytics is another. These are global associations of bodies which publishes or provides data repository for you to actually look at what were the issues that these companies or these industries have faced in the past. What kind of liabilities did they have from that? I'll give you a classic example. This is a Taiwanese company called Formosa. They had a steel plant which they were building up in Vietnam. Now, it's a pretty well-known case. It's been there like last 2 to 3 years ago. So one of the issue with that project is, and apart from the other lenders, it's pretty much there was an EIA. EIA is the Environmental Impact Assessment Report, which was published. The financiers looked at those reports, and then they went ahead and started funding that project. Now, as the steel plant started coming up, there was one gray area. So next to the steel plant, there is a river belt. And what is happening is the waste from the steel plant is going into the river belt. Okay. Now, as per the original plan, yes, it is actually within like a 3 meter inside. The pipe is going 3 meter inside, closer outskirts of the river belt, but it is still going in there. That river used to be a livelihood of a lot of communities residing around it. So it was pretty much a fishing belt. What happened is the fish started to die, and that affected the livelihood of people there. So obvious fingers get pointed over to company which is operating close to it. So people started pointing fingers on Formosa. You have a plan by which we believe that the water is getting spilled over from your network or your waste resource into the river, and which is causing this. People can imagine the kind of impact it had. There was wide protest, not just on the company, but also the government agencies. Okay, it went on for like 2 to 3 months. And after that, eventually Formosa had to settle. There's a high penalty, it's in millions of dollars that we could talk about, that Formosa had to settle so that these people's livelihood can be taken back into consideration. So, moments like these, when we don't do that extended due diligence, you may end up in a situation where your model of financing, now this could be a 5-year, 10-year loan, but effectively when we as risk managers, even I'm also guilty of it in the past, we look at the financials, we typically ask, okay, what do you do? How much revenue would you make? What is your cash flow profile? So we always ask the what question. Okay, what is more important is we should ask the how question. How do you do it? Okay, how is it that you have decided to run the business model? Okay, how did you do the EI assessment? Did you actually get any consultants involved in this? Is there an impact assessment done? Do you have a sustainability plan for it? See, what I want to take people away with is the fact ESG is there. To the point made earlier, every financing should be sustainable. The question is, how do you make it sustainable? And people should get enough opportunity to get there. You may not be there on day one, but you can be there in 10 days, a few months, or a few years. What you really want to have is a milestone-based approach, where banks as financiers and even the other financiers working with corporations can get them there, where stage by stage they adhere to a milestone, and eventually we all achieve the target that we want to get to. That's how we could make every financing more sustainable.
Wow. So let me summarize 3 steps. The first step is get the basic right, which is about the policy and the monitoring. The second step that Citibank had was to look for standard in each sectors. And the third one, which is quite profound, is to start asking how instead of what, because how leads to how your clients deal with ESG. So that is very interesting. So come back to DBS. So after the wake-up call, what has the board and the management interact differently?
Yeah, thank you. I'm very proud that in DBS, sustainability as a subset of that, responsible lending, is led and actively engages the CEO. So from that perspective, we got a lot of top management support for the effort. But more importantly, I want to talk about the need for the board to be actively involved. And I see at least 3 reasons for that. The first one is that any of these decisions that you'll have to make requires a trade-off. There are no obvious easy decisions where it becomes very clear that you must exit somebody or you must reduce your exposure. There might be cases, but they're not always obvious. So the board needs to make some of these political sensitive decisions or be involved in them. The second one is that, as many of you probably are aware, you can't disaggregate social and environmental impacts. They're all connected, and sometimes in a very, very complex manner. And the benefit of having the board involved is that board members have a perspective from other industries that they come from, and therefore they can very much fuel a debate that you would need to have in your boardrooms around what have they seen. And although banks have a relatively wide perspective, we at least have seen that significantly benefit the discussions that you need to have. And then thirdly, it's about making sure that the board stays well informed. And I'll give you a little anecdote from our latest annual General Assembly. And this came after a point in time where we just exited our coal-fired power plant lending. But still, we had questions coming from NGOs, and quite vocal ones. And they used a lot of jargon. They used a lot of acronyms in that conversation, and the questions were addressed towards the board. And so for the board to be prepared, or at least somebody in the board to be prepared to answer these questions, they need to have a certain level of understanding about the issues, because they will have to expect that some of these questions can come, and there is, as you probably know, at an AGM, there's no time to really get an explanation and ask questions back. You have to answer in a credible way. So at least for those 3 reasons, I think it's critically important that the board gets involved. In our case, I've been together with the CEO in front of our board quite a number of times within the last couple of years, and they always left us with new insights and with fairly good directions on where to go.
Thank you. Well, Edward, so after the wake-up call, what's happening right now?
Yeah, sure. So I mean, there's a few thoughts. I think, as I mentioned earlier, the boardrooms in Australia have changed significantly in the last year in particular. The conversations have become a lot more challenging, more exploratory in nature. But management have also been set with the task of making the reports, the data, the information, the discussions at the board level more relevant and more engaging. Too much in the past, there was a culture of just show them everything. And so I'm sure many of you have very, very large packs to read as you're sitting in a board discussion. And that was management's way of safety, right? It's very safe for them to provide all the information to the board. And therefore, the directors have to wade through all the information and make a call themselves. Very challenging now for management to actually come up with coherent, targeted papers which are directly addressing the focuses. So there's been quite a big change in just the structure of those board papers, frankly. What assumptions are we using? What are the key issues that we want to bring to the board's attention and so forth? So that's working, still work in progress, but I think it's a nice change, and I think it's a good change. That then allows the board to be more challenging in the right areas. The makeup of the board is important. Things like cyber and technology risks, anti-money laundering, who on the board can really represent some of those issues without everyone being specialists. We're seeing more, and we get involved in these in the roles that we play, workshops, more discussions on particular themes, anti-money laundering, cyber, maybe it's around digital, changes in digital, what that means. And so the board education sessions are increasing significantly as well, which we think is really important. One thing I will mention, which I think is a change in Australia in particular, and we see it's quite an encouraging change, I think, is the reporting around customer complaints. And this relates to conduct, but it also relates to the board being so far away, and even the executive so far away from what's going on in the coalface of the organisation, that too often you'd have net promoter score reports talking about how wonderful we are and how everyone promotes us. Very little, if any, reporting on customer complaints. And through the Royal Commission and the CBA Prudential Inquiry, it's been very clear that actually those conversations that the sales teams, that those out in the suburbs, that the discussions that they have in the wholesale space, even getting customer complaints through from the trading desk, provides a very, very nice view of what's actually happening in the organisation. So the banks in Australia, one bank in particular, has a specific executive role now, which is all about the customer, a customer advocate sitting on the executive team. And the reports every week to the board on 3 or 4 customer complaints that week, what the customer said, the board, each director gets that, and they then have an idea of what's really going on out in the organisation. So I think that's a nice change. Again, that there's a challenge here, obviously, on the board getting too involved in what's happening across the organisation. And so that, the pendulum, we have a typical consulting picture of the pendulum that shifts left to right. At the moment in Australia, it's very much shifted to the right, where they're a lot more involved in what's happening through the organisation. I can imagine that can shift back once some of these fundamentals have been sort of bedded down and more embedded than they were prior.
Thank you. Well, that customer complaint is really interesting. It has something to do with your last comment, and Mikkel, and I'll let you throw in. Board must stay well informed, and this is that, right?
Yes, it is. And I couldn't help but thinking about something that had happened to us recently. We added another board member who had a specific focus and knowledge around technology and digitalization, something which is core to our operations. And one of the things that we've had to discuss a lot more recently is the idea of responsible data use. So how do we feel about sharing information? How do we feel about the use of information, for example, as artificial intelligence is being used for lending decisions? How do we feel about what social information that we use? How do we inform our customers of where these decisions are being used for? And we have a whole, yet another committee, but a committee that looks at some of these things and challenges some of these case studies that come up. Because again, I think it'll be foolish to believe that any bank at this point in time knows exactly what the right position to be in this is. But we try to approach this by using principles of how would the customer feels if you knew about these things. And this has led to a whole new set of discussions, which I think does already engage the board, but that you need to take another decision on based on the balance of you having a commercial opportunity, but also being responsible to your customers. So I very much agree with that.
Well, that takes us to another level. You have anything to add on that point?
That's pretty much, it's well summarized, to be very honest. It's all with the tone that is set. And when we talk about tones, don't be organizational silo specific. Looking at the board and then the members, then the bankers. No, it should go beyond. As you rightly pointed out, knowing your end customer becomes very important.
It starts with the customer. One thing that we discussed and it was very interesting is the word ESG, and we always, actually sometimes using ESG separately can undermine the reality of how the world works. And we talked about that. Some of the environment may impact the social, right? And we talked about palm oil. Can you talk a little bit about that? That sometimes, in many ways, the board and the management has to be sensitive to how to manage and price ESG, not separately, but together. So who wants to start first? Mikkel, please.
I tend to think that that's the hardest problem to tackle. Because so everybody who some of you may be familiar with the idea of system thinking, which is this idea that one thing leads to another, and you can draw the network extremely complex and really large, because at the end of the day, everything impacts everything. The challenge is, of course, to not make it more complicated than you can actually act on it. So we have had, we were about to have a session again with the board and with senior leaders in the organization, where we're going to try and explain some of this complexity and try and show how environmental impact leads to social impact. And the classical example is the water, food, energy nexus that some of you may have heard about. The fact that water is needed for energy, energy is needed to create food, and both of them are needed. So all these things interact, but I tend to think that it is very easy to talk about system thinking. It is extremely, extremely hard to implement it in a way so, as I said, you can make decisions on it. And I think sometimes we end up in analysis paralysis, by which I mean we know a lot of things, but we don't really know what to do with it. So I tend to think in your famous pendulum, when you read the debate right now, it's swung very much to we must think system thinking, and I agree, but we got to swing it a little bit back and say, but still we have to make decisions in the context of right now, and if environmental issue is the biggest issue facing this particular industry, let's focus on that at this point in time. But it is fair to say, and I'll stop with that, that we have to remember that sometimes when we think that environmental issues are not social issues, we have to remember that those who are most impacted by environmental degradations are the poorest ones in our society, because they're least prepared. So tackling environmental issues is also tackling social issues.
Well, one quick thing I'll say on that, which I completely agree with. With all of these, I mean, a lot of this sounds quite doom and gloom, right? A lot of this. And what I think is a big risk here is that the banks respond by putting more and more and more governance and policies and processes in place, and think about those who need to operationalize all of these changes. The policies that need to be put in place, how do you actually have those engaged? The sheer number of policies and procedures and controls that the bankers need to have or need to know about in order to do their work. That's just getting harder and harder and harder and harder. So with that, you either think about more tactically, more strategically around how do you operationalize all of these changes? How much is too much? What sort of support do they need? Be that funding, be that first line support, be that risk frameworks and the like. Risk managers these days need to become a lot more holistic in their thinking, and it relates to ESG as an overall package rather than E, S, G. So I think it's important to ensure that the operationalization of all of these changes is considered when putting these changes in place. Otherwise, you will overload the organization and we'll get into more trouble.
Thank you. And thanks, Edward. And that kind of put a spotlight on Shreejesh.
Absolutely. No, I was about to get there. Don't overkill it. Okay, that's the real message. You will never get the sweet spot. You will never hit the sweet spot. As a banker, and as a risk manager, my obvious question is it something that you can actually look at a credit at a point in time, look at the ESG issues, and say, okay, I'm okay with it, let's approve the credit and you're done with it? It's never like that. What is important and how we could get there, and indeed, in today's world, organizations are shrinking. So, the amount of resource put on risk management, the amount of regulations which are coming is on the opposite direction, whereas the resource is pretty less. So how can you be, the way, I'm just choosing the right word to say here, how can you be better equipped, or rather be smart in doing it? Okay, the first and foremost way out is build that culture. When I say build that culture, not just internally, outside. If you build that culture across organizations where you ask the right question, I'm coming back to the same topic again and again. The reason is because once you go outward, you are probably trying the others to be more behaved so that your work is cut out. Because if you start policing each and every person, you require that kind of infrastructure and resourcing. Rather, if you go out, outreach, get them to get behave, this is what our expectations are. And collectively, if all banks are doing that, I think that is the biggest advantage of this forum. When the regulator steps in, comes out with a sustainable banking guideline, which actually inculcate a responsible financing, kind of a culture across banks, then every bank will go and ask the questions to the corporate. So if you're banking 100 clients, everybody else is banking like 1,000 clients together. When you start that culture, automatically, these kind of disclosures that we are talking about becomes part of their DNA, becomes part of the annual assessments or annual reports that they publish. They know how to respond to the questions that you pose to them. So what does that mean? Then your work gets cut out, because now you created that kind of, it becomes BAU, right? At that stage, you don't have to invest in those kind of resources. You rather have to be more cautious about it by, in a way, I would say if you're doing long-term financing and stuff, you need to have ESG-based governance into it. Okay, just to make them accountable towards it. Okay, this is what we discussed, let me covenant it, saying that you would provide me disclosures around it. This is one way of policing, because you really cannot keep tab of every client at every point in time. You should rather build that culture in such a way so that it can create that reciprocal effect towards you.
Wow. So you just point another interesting point, which is how the bank works together, right? So how do you see what work and what does not when the bank work together to address the ESG issues? What is the good practice that we can learn from? Yeah.
I think Singapore provides a couple of good examples here about what both the regulator can do, but what the Association of Banks can do. And it's very much as you say, as long as you create a minimum standards, then you do not disadvantage anybody and it doesn't become a competitive issue anymore. Because it is hard to go out and ask those difficult questions if you're the only one asking. So the Association of Banks in Singapore came up with the responsible lending guidance that made sure that everybody asked a certain set of questions. And as the regulator is exploring coming up with guidelines as well, that will further amplify that. And I think the holy grail will be when there is a suggested set of, I don't know if you want to call them set of questions, but certain questions that you are expected to ask, and you will get this information on an ongoing basis. So the power of creating a non-competitive environment between the banks and letting them act together is quite important. The other thing, and I give a lot of credit to WWF for that, is bringing some of the banks together in what we call ASFI, which I can never remember what that acronyms mean, but it's a very important one, I'm sure. But it's basically a learning forum for banks to understand what are the issues are, because we are deluding ourselves if we think we understand all the complexities of this. So bringing together in a safe forum banks so they can openly talk about what some of the problems are actually also helps quite a bit.
Shreejesh?
Just to add on, this is just an additional, I'm not saying that you should adopt one or the other procedures or a standard which is there in the market. It goes back to the EP and IFC. One of the important element of why that standard is good enough beyond the procedural stuff is it requires all those banks who are actually EP signatory or actually participating in an IFC flagged loan to have common standards, okay? In asking the same question, putting the governance appropriately, plus there is an audit process. So basically in that audit process, what has been done is, for a single project loan, all of these banks are asked to provide, what has your assessment been? And they will try to get to a singularity between all of these. It's not blaming or shaming one versus the other. It actually, in a way, what happens is, because of that, every time there is an EP loan or IFC-backed loan, natured loan, the point is the banks do interact. So basically, example, Citi versus some other bank, which is also participating in the same loan, there's a level of interaction on ESG which comes into play. Okay, it's as if, okay, we have looked at this. Have you looked at that? So that's, it's a collaborative learning. It's a collaborative learning which happens in EP and IFC. We could have, and this is something that I've been saying in various other forums also in the region. You can have a country-specific forum. There is a council created in the country where these kind of you did not name a transaction. You could probably bring it up for discussion. People can brainstorm around it. That's how you get to a stage where you actually build up a standard by your regulator or by the country from that perspective.
Maybe ESG is more about collaboration than competition. And
Just a quick comment on that. I see there's several layers to that. One is ensuring that there's a global consideration for any of that collaboration. So at times organisations get too insular, I think, and they look at themselves and they believe themselves too much, right? They sort of look at themselves and go, we're great. And so the more global collaboration, or at least awareness of global standards and practices and sharing perspectives with peers globally, I think is the first layer. The second layer is local, obviously, in Thailand. And we see in Australia, the Australian Banking Association playing a very, very big role in bringing together all the banks. And for example, recently coming out with an Australian Banking Code of Conduct, which lists out 8 things that all banks have signed up to as far as how they were going to engage, from a responsible lending perspective and so forth with the economy and with the community. And I think the regulator can't really do that, right? I mean, it takes an association like that to ensure that happens. So ensuring that those there's forms for that in each economy, I think, is very, very important. But I think culturally, it's around not having an insular mentality. None of this is competitive. You can all share from each other's learnings and experiences. But the challenge is actually being honest with yourself around where we are versus what we hear from others and having an open mind.
Thank you. It's been a very, very fruitful and very productive conversation. But we would like to hear from you, from the floor. If you have any question, please feel free. Any question at this point? Oh, please. Dr. Suthat, please.
Looks like there are microphones coming up.
You have the microphone.
It's a very interesting discussion about sustainability. If we look back and we try to analyze what the banking sector has done, I think they are both sides of the coin. I think in the past 100 years, banking sector has contributed enormously toward the growth in the world, but it also contributes very negatively on the income distribution side, because it actually the distribution of wealth has become much more biased because of the banking sectors, and because you tend to award success and the big ones, not the small ones. So if we start looking back at what Shreejesh has mentioned, if you look at this industry standard that we have accomplished, you find that banking sector actually has a lot of dirty things that we have done in the past 100 years. But that aside, if you want to look into the future, I don't know how much lesson we can learn from that. I'd like to ask the panel. We now have a lot of challenges in the banking sector going forward. In fact, the whole financial service going forward. And we now know that we have created a lot of sins. Not, we can say it, palm oil and coal and others, but the banking sector has its big sins also we have created. And how do you want to take this forward into the future? So that's the question for the floor. Thank you.
Well, recognizing it's a sin itself is it's a big plus. I salute you for that. But on the other side, well, I also want to be very clear that not everything that a banking sector has done in Asia Pac, you have to, although I come from a US bank, the reality is the way we should look at the world shouldn't be one, at least in this aspect. Every country has a sweet spot. If I come from India, basically, that's where I'm born and brought up. Power is in crisis in India. Obviously, you need more power plants and stuff. Now, in India, if I go in and say, okay, just use nuclear technology, okay, go around and do a solar power plant, wind power, that's not a sustainable model. I tell you why. Because that's a country which is rich in coal. Obviously, it has to be coal-fired power plant. But you have to put that sweet spot, whether you're going to get 30% coal or 50% coal. On top of it, what technology are you bringing onto the table? Right? That is really important. So within coal, not all coal is bad. Okay? There is ultra supercritical technologies too. What is it that we are doing? So if India wants to do that, okay, what is the government doing for it? Is it subsidizing that technology? Is it allowing people to be creative, do research into getting in those technology? So what I meant by that is every country has a sweet spot. Indonesia, two big industry in Indonesia is coal and palm oil. If you shut this business, then Indonesia is nothing, right? I mean, they don't have an alternative business model. So the only way that you can do that is, yes, we have done our sins. How can we correct our sins? And we need to give that opportunity both to the banks and corporations. That's what I believe. So I'm a firm believer that this is not something which is going to turn around for us in the next year or two. It will take its own time. It will take at least 5 to 10 years. But what is really important is who is driving it? How are we trying to drive that conversation with the clients? It becomes much more critical. So Indonesia will not be a non-palm oil producer tomorrow. They will have to, right? But how can you make it more sustainable is important. And we were talking about this in the room, then we were discussing it. The point is there an alternative for palm oil in Indonesia today? Not really. Nothing comes as cheap as palm oil. So this would be there. This would sustain for the next 15, 20 years. So we have to do that. The other question on what could we do about the social aspect of it, I would talk about, because you mentioned about the income disparities and stuff. Now, half of the livelihood in Indonesia is reliant on this, we call it the small producers. Okay, these are small farmers. They are not going and doing a lot of encroachment, but they have created. So burning, for example, okay, the whole issue about haze and smoke was because of the land burnings. Now, land burning, this is what they have been used to in the past. So they have not been educated to have an alternate method. And whenever you bring out an alternate method, obviously there is more to be done than a financer or a bank. What is the research institutes doing in Indonesia? What is the government doing in Indonesia? There should be an alternate methodology which is sustainable in a cost-effective manner. And it takes time to get there. So I'm completely with you that we have done our sins, but every small step is still better than doing nothing. That's what I believe.
Oh, well, it's a very, very big question, so thank you for it. And I'll borrow a little bit of what you said. I think as banks lending to the real economy, of course we're part of the culprit, because as long as we lend to the real economy and the real economy is living outside the boundaries of what this planet can take and still not meeting the social needs, yes, we have a role to play. The philosophical answer, I'm told, to your question should be that we should think about being regenerative and distributive by design. And what that means in less fancy words is we have to think about not taking away more from the natural resources than we give back. And we have to make sure that everybody can get on the ladder to ownership so that we don't have a distribution system that gives everything back to remunerating financial capital. I think that's the textbook's answer. But I think the practical answer is very much what you said, which is an increasing understanding that the answer is different from each country. And we in DBS has been inspired by what some of you may have heard about. It's called the donut economics or safe and just operating space. That doesn't really matter. What it basically means is finding out that you got to lift people out of, give them the basic needs without breaching what we all have to live on the same planet. And if you're in Indonesia, your decision making is probably fairly different from if you're in the UK, even if you're looking at the same sector, because the environmental damage that is being caused in some of these countries are very different, and on the other hand, the social needs of these countries are very, very different. So starting to appreciate that and eventually measure that will make all the difference so that you can actually make intelligent decisions. But one of the things we haven't had time to talk about today is the difficulties in measuring some of these things. Yeah, now we've done an honest attempt at it in DBS, and we're about to embark on another journey that will do even more of it. But thinking that you can get 100% precisions in the same way as you can with financial numbers is just never going to happen, right? So you got to be able to make decision with much less granular information and still try and do what's right in the situation. So we have that framework to think about it, but you got to develop something that allows you to make the decision that you think as a bank is the right one. I don't think I solved the problems of capitalism with that, but at least I gave my honest shot.
That last point is really important from a non-financial risk perspective, and actually measuring that is incredibly challenging. But that's where we see more uses of stress testing and scenario analysis. We talked about that in the climate elements, which is really good. The big question, but I don't know if you want another answer, but a short answer maybe. I think for me, I think in this day and age, with the amount of flow of information from a media and a social network perspective, I think the industry, as a global industry, has learned. Right, I think the global financial crisis, the fallout from all of that, the payment protection insurance issues, the anti-money laundering, you name it, it's a long list. And I think that the industry is aware of those changes, which I think is a tick. What are they doing about it? That's the challenge. And so for me, I think it comes down to quite simply, what's the purpose of the bank? What are the values of the bank? How do you test yourself against the purpose and those values? And what is your purpose, in the sense that you have stakeholders, be that regulators, shareholders, employees, you have the community as a stakeholder, which has been accentuated more than ever. So as you think about those stakeholders, what is the purpose of the organisation? What are the values of the organisation? And how do you test the firm's behaviours against those values, I think is the path forward, or a path forward.
Thank you. Any other question? We can take maybe two more. Oh, please. Up there.
Dams Godasap from Exim Bank. I thank the presenters for an interesting discussion. Having an ESG policy in place and implementing it requires a sizable investment and, of course, time and commitment throughout the organization. My question is from the experience of the EU and the OECD. Can you please point out to some of the available studies that tells us that the investment eventually pays for itself, both in quantifiable and non-quantifiable terms? Thank you.
One for the practitioners, maybe.
It's a very direct question, and to be very honest, I have to give an honest answer. It's not fully quantifiable, okay? And it's a choice that one makes, okay? So what does that mean? It's not fully quantifiable because, any investments, whether it's banking or any other, it could be technological investment, it could be anything else, any other corporations for that matter. You need to get to a scale, okay? You take an initiative, you put up an infrastructure yourself. Unless your competitors are also catching up with you, you will never get to that scale. The moment you get to a scale, either you have to get to a scale yourself, or you have to get the industry to a scale by which you can monetize the cost which comes out. That is true for any capital investments or any investments of this nature. Now, so that's an honest answer as to say why it is not quantifiable. Yes, you can always rely on some of these banking forums, coming back to what IFC has done or EP has done, or even the Association of Banks in Singapore. But some of these have not even costed them much. To be very honest, they haven't paid a price for it yet. And what I mean by paying a price is it doesn't need to create an infrastructure. What you need, okay, and this is from our experience as to what we need, and I believe DBS or any other bank would have the same thing. And that is something is probably lacking, or probably something that a local bank, including what the banks in Thailand, could probably work on. ESG is not a very simple topic. it's not as analyzing numbers and getting through, finding out ratios and saying, okay, whether this meet, okay, tick the box. You need specialists, okay? Now, either you have to hire those specialists, which is expensive, okay? Or you have to rely on a body which actually has specialists and provide this information. Now, to an extent, what we have done. So we have a specialist team sitting out in New York, which actually covers entire Asia. So it's a team of only 4 people. But these are not bankers. These are really people who have engaged in the past ESG issues, either from an NGO or a corporate angle or otherwise, who have that rich skill of experience or rich experience that they can probably bring up to our table. So as risk managers, what we do, even though I'm not a specialist in ESG from that perspective, because I have that experience, but the people that I'm talking about has been a stalwart like 20, 25 years in the industry. So they, these people have a different IQ level when you talk about ESG to them. So leveraging on those kind of specialist resources does help for you to, because effectively any risk manager won't be so skill worthy to look at, okay, if I have to do a palm oil, do I look at slavery there? Do I look at child labor there? What I'm going to go and ask the client in terms of understanding child labor? Many instances the client would say, no, we don't do child labor. But how do you get there? There is an audit process, right? And there is actually a tick box in an audit process. So there is a specialist involvement coming into play. What you could leverage on is, as an association, you can put up a specialist body. Right? That's something that Singapore could have done. That is something that Thailand could do in the future. You can leverage on that. So the cost gets seamlessly, proportionately allocated. That's one way of looking at things. There's no one-fit solution. It's all, we have been innovators. We are trying to innovate. And that's the reason why this is a discussion forum.
Please.
I was tempted to stay quiet, actually, because I'm also not aware of any particular study that answers the question of should you set up an ESG risk function for this. There are plenty of studies that showed that companies who focus on material ESG issues outperform. I'm sure you've heard of those, but George Seraphim of Harvard Business School is one of the leading researchers in that, and that in itself tells you something about the need to be lending to companies who treat environmental and social issues and governance issues with care. I think also there are methodological problems with trying to do that study, because you'd be asking the question, what if I had not declined a lending, would I have made a loss? And that's normally internal data that banks wouldn't kind of share publicly. So it's probably also hard to do. But I think the most obvious evidence is by looking at some of those who had real tarnished reputation damage. And here I'm not just talking about those who have a measured brand value. You can try and see if there's a correlation to their brand value, but simply also from the inability to attract staff because they don't want to be working for a bank who does this, and that. And so, as you rightly point out, that's highly difficult to quantify. And that's not a satisfactory answer, but I think there's enough gut sense in me that says that I don't want to be the bank. I don't want to work for the bank who does things that are not, congruent with what I believe in.
Final quick thing is I've seen and I'm seeing more equity analysts and brokers publish ESG reports on banks. That, comparing banks in particular markets on their overall ESG frameworks, the seriousness that's taken and so forth. So clearly there's a tangible value in that.
I can cite an example, if that helps, in the Thai context, okay, that people can relate into. So we remember a couple of years ago, we had a fishing slavery issue. And, it became we were watch listed for that. And it required a task force to come together and, work towards it. Now, interestingly, I'm referring to large corporates here. I don't like to name the corporates, but really there were 2 corporates. And you would know what I'm relating to here, those 2 corporates. You could find out the difference between the way both of them responded to the situation. Now, there is one, which is both of them are large global companies. One is pretty much Thailand and then going global, whereas the other has a lot of international brands with them. Now, once you go back, most of you would be aware of it already, but once you go back, look at those 2 companies, the way they disclosed it, the way they articulated the steps, the way, how to get it done. One company actually went ahead and said, I'll do 100% of audits for all my catches that I get from local people. I'll try to ensure that that is done within the next timeline of 12 months. They did that. Okay. The other one said, I would actually go and figure out what can be done. Let our board is investigating. So that is more like a wishy-washy. The earlier company which actually did the audit, they went a step further and said, look, I'll ensure that all of my sourcing can be tracked back in the next 2 years. What it means is tomorrow you take a product in UK from the shelf, you scan the barcode, you can get to the point where that particular shrimp or tuna or whatever has been fished, okay, which date and how. So, that is the way, what we are talking about here is the way people actually take it into their perspective and how do they relay it out. So over-communicating is always helpful.
Perhaps I could squeeze the last question, which has been asked from the floor. And the question is, how do banks perform and implementing ESG, and at the same time has to perform our duty as financial intermediaries? Are you suggesting banks not to lend to certain companies or sector that is not ESG compliant, or are you suggesting different pricing treatment using ESG score as a part of risk premium? How can this work for developing country? So can we make it quick?
There's a risk appetite element to this, right? And so to what extent is it within or outside a risk appetite? And if they're on, from a policy but also a risk appetite perspective, would be my answer to that.
Completely agree. To your point that you made, whether from a perspective of a developing country, it's a risk appetite of the regulator, it's a risk appetite of the industry, okay? And having said that, we should get to an adoption of ESG standards across the industry-wide, but you should always create that differential in pricing, because you are taking that additional risk. There is a possibility of your credit getting deteriorated much faster, which would yield you to put up additional risk capitals and provisions. So you should price it off. If you are probably closing your eyes on ESG, then probably add 20, 30 basis point to that so that you're covered off in the future.
That's why we have this session, because we underprice it. Okay. Well, the time is up. Let me summarize. This is a great session. What I got from this session is, of course, we are the gatekeeper of public trust. We are the gatekeeper of public trust. The government of Bangkok, Thailand said, let's look far, look wide, but we have to look close also. Look close between how board and the management work together, what kind of information got feed up to the board. Is the board well informed? You just mentioned about customer complaints, which is a great example. Let's not talk about what, but about why and how. We talk about what is about the template when the bankers has to approve something, right? But does the bank go and ask how you generate that kind of revenue? What is the impact on ESG? So that is the how, and the why is why we exist, what's the purpose, the culture. And ESG must not be looked individually as template, but it should be integrated, because that's how the world works. If we look at it as a template and separately, the group of people who get hit badly is the poorer people, the people who have no opportunities. So maybe this is a great summary for this session. Please give a big hand to our panelists. Thank you very much.
Thank you so much, Mr. Kulvech and our panelists, for the engaging session. And thank you, everyone, for all your questions. We'll now have a 15 minutes coffee break. We'll meet back here at 11:05 a.m. I would like to make one lost and found announcement. We found a missing phone, so if you're missing your phone, please go to the information to collect it. Thank you.